The United States has avoided a potentially catastrophic economic default by the skin of its teeth. President Obama has signed the long-awaited deal that puts the government back on track and raises America's borrowing limit. But it's just a temporary fix, as Anissa Nawe reports now from Washington, D.C.
Well, just hours before the deadline, the so-called 11th hour, really coming down to the wire here. The House of Representatives passed the Senate bill to raise the debt ceiling and restore government funding after a 16-day shutdown, barely avoiding a default on their almost $17 trillion in borrowings. After the vote, some bloggers joked, "See you back here in 3 months." Now, that's referring to the fact that this is really not a long-term solution to the budget crisis. The U.S. government is now funded through January 15th and can keep borrowing until February 7th, but really they've just kicked the can down the road. Some say Congress couldn't agree on a budget for the last 2 years, which makes it unlikely 3 months will be enough for a solution. Not to mention the damage that's already been done by letting it go this far. This shutdown didn't save money, it cost money. According to Standard & Poor's, $24 billion. The world, of course, watched Washington very closely this week, as Senator Harry Reid mentioned Wednesday, but many might disagree overseas that this last-minute agreement shows how responsible America is. Quite the contrary. China already announced the need to de-Americanize. The dollar is not the currency the world wants to bet on anymore. The IMF, the World Bank, the global economy can't afford to come this close to recession due to internal partisan politics in Washington. Now, another interesting point is that Republican leaders probably could have mustered this support we saw on shutdown day 16 back on September 30th, and this self-inflicted halt on Capitol Hill would have been avoided altogether.
The budget brinkmanship has cost the world's largest economy billions of dollars, as well as the trust of investors around the globe. And it also sparked calls to de-Americanize the world economy. Let's talk more on that with Martin W. Haneke, chief economist at the Henley Group. Mr. Haneke, would you agree that the recent crisis in the U.S. is a wake-up call for the world to change the financial order?
Well, it isn't the first time, they've had a similar problem. So I doubt that this is a wake-up call, really, or enough of a wake-up call this time around. And what the world really needs to understand is that the whole issue isn't really about an agreement or non-agreement, or, after 3 months when they have to sit down again. Even if they find a compromise that's long-lasting and they agree on it for the next whatever, how many years, or even if they agree on taking the limit of the debt ceiling away altogether, well, how is that positive? Because the problem isn't really the debt ceiling, the problem is actually the debt. And the real issue, from our point of view, the investors and also other central banks should be looking at is the danger of the growing debt, and now more recently coupled together with the issue of rising interest rates. And that's another very interesting thing to watch, because yields on treasuries have been rising lately, and that increases the debt servicing, debt financing costs of the United States. And at these levels already they're struggling with these higher costs. So any further increase in the interest rates generally and on treasuries would possibly send the United States into default, and not by disagreement, but just because they run out of money.
So, with the dollar suffering such a huge blow, and is still the backbone of a lot of world currencies, shouldn't investors alike and nations be thinking of alternatives and contingency currencies to reduce the future reliance on the dollar?
Yeah, absolutely. You know that China made some comments in this regard. But I would distinguish here, though, between private investors and governments. For governments right now and central banks who already hold a lot of treasuries, it's kind of too late to exit them, from the investing point of view. Because if China started selling their treasuries any significant amount, you would see yields spike immediately, and that would send the debt servicing costs right up, and the U.S. Budget and deficits would go through the roof quite fast. Investors might panic, and then they cannot sell off the remainder of their bond holdings. So I would actually think that China understands probably a good part of these U.S. Treasury holdings that they hold as part of their reserve currency reserves, they will have to write it off eventually. For private investors, though, who hold small amounts, I don't see any reason why they would want to hold any treasury exposure. So we think the bond market, the treasury bond market, and also, by the way, most of the Eurozone sovereign bonds is one of the biggest bubbles out there they shouldn't hold. Gold, on the other hand, would be a good alternative, certainly for private investors. China is trying to buy more gold. They actually imported over 2,000 tons of gold over the last 2 years through Hong Kong. They are trying to increase the gold part of their reserves, but they are so big, of course, that it's difficult for them to do that without driving prices up. The recent correction, though, offers them a good opportunity, and Russia and China are both buying.
So looking at what's happened in the last couple of hours with President Obama signing that bill, the debt ceiling has just been bumped up again. I mean, the bubble will explode eventually, but what will that all mean for world economies? What would that mean for the rest of the world?
Well, it's a question when you say the bubble will explode eventually. Well, in 3 months, there might be a surprise. When they sit down together and negotiate together in 3 months, maybe they will find a longer lasting agreement. It could be. But again, as I mentioned, that's not the solution because the debt is the problem, the rising interest rates is the problem. So what does that really mean for the world? Would the US really default on its debt? I think more likely what they will do is just continue the quantitative easing policies. Maybe even they will have to expand quantitative easing rather than tapering, because tapering would immediately cause interest rates to go up. And what that means for the world is it's quite likely inflation may pick up in the United States, possibly significantly, when investors realize the real predicament the US is in and that they will sacrifice their currency in order to avoid the debt trap. And so this inflation will probably be exported to all other countries globally, and so tangible assets is something investors should be looking at for safety from this, rather than holding majority of assets in cash or bonds.
Tangible investments is what investors out there should be looking out for. Martin W. Haneke, Chief Economist at the Henley Group, joining us this morning to discuss that bill.